The U.S. Central Bank on Wednesday decided to leave interest rates unchanged once again, acknowledging the U.S. economy's surprising strength. But the possibility of a further increase in borrowing costs was not ruled out. Our Ahn Sung-jin reports.
The U.S. Federal Reserve has decided to maintain interest rates in the 5.25% to 5.5% range. This was the second consecutive meeting after September, where the FOMC held rates steady at a 22-year high. The decision is mostly attributed to a slowdown in inflation, as the consumer price index recorded an on-year decrease, while the U.S. economy has been growing at a constant pace over the past month, potentially increasing the growth rate to the 2% range. An increase in the government bond rates also reduced the need for additional interest rate hikes by the Fed, as borrowing costs for households and businesses rose.
Recent indicators suggest that economic activity has been expanding at a strong pace and well above earlier expectations.
The Fed's second straight pause follows a series of rate hikes over the previous year and a half, including 4 in 2023, as the committee fought to tame high inflation. Though inflation has cooled since last summer when prices peaked at a high unseen in nearly 4 decades, inflation is still lingering above the Fed's target of 2% per year, hinting that a future hike may be needed.
But a few months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. The process of getting inflation sustainably down to 2% has a long way to go. We'll be looking at all of those things as we make a decision in December. We haven't made that decision.
The latest decision also means that the rate gap between South Korea and the U.S. will remain in the 1.75 to 2 percentage points range. Ahn Sung-jin, Arirang News.